everyone, welcome back to Yuri's Box. In this video I'll go over the CPI data that got released today, as well as quickly go over the JOLTS report and how it is affecting the markets. If you like this kind of content, consider leaving a like, and as usual, nothing I say in this video is to be considered financial advice. I just want to take a moment to thank everybody that left a like, a few of the comments, and really the anyone that subscribed to the channel. I definitely wasn't expecting things to move this fast, and all I can say is thank you. As far as the numbers are concerned, we had CPI come in cooler across the board. Headline inflation came in at 2.8%, a drop from previous read in January of 3%. Which you can see right here on the chart. Now, you have two very different reactions. Let's start off with the bond market. So the bond market is actually selling off. We see higher rates on the back of a cooler report, which is at the beginning quite counterintuitive. But I actually saw a nice thread by Nick Timoros on X, kind of explain everything, and basically the idea is that most of the cool down in the CPI report came on the back of airfares. And since airfares don't really have a way of showing up in PCE, which will get released at the end of the month, if I'm not mistaken, the bond market is extrapolating that, yes, it was a cool report, but the PCE number that will get released later on could be hotter. Okay. And it's kind of the opposite move that we saw last month. It was actually a month ago. Okay, and I remember it because it was actually my first video. I made my first video on February the 12th. So you had a hot CPI on the 12th of February. Yields went higher. The next day you did have PPI coming hotter, but because of the components coming in a bit less hot than the market was expecting, the bond market extrapolated that and again kind of priced in a cooler PCE report. We're kind of doing the opposite now. The bond market is going up on the fact that it is expecting, based off of these numbers, a somewhat less benign PCE report. So that is how you have to think about rates. We'll see PPI, if I'm not mistaken, tomorrow. Yeah, PPI as well as initial jobless claims. Keep an eye on bonds. Again, keep an eye on the data tomorrow as well, because just looking at TLT, I've made the case many times for a possible retest of the trend line we broke out of back in February 21st. Does it have to happen? Absolutely not. Currently, we're holding support at the bull market support band, which is nice to see. If we were to see kind of data be supportive of, again, less inflation and possibly initial jobless claims come in a bit hotter, it could just reinforce the fact that we're just holding support at the bull market support band. Overall, though, it wouldn't shock me if we were to see something come along that makes bond retest the this trend line right here. Does it have to happen? As I said before, no. Could it happen? Yeah. So I'll let you decide. Really, I'll defer to your judgment on that. It's just something I'll point out. In any case, on the stock market side of things, we're actually seeing actually things sold off a little bit more. We were up over 1%, if I'm not mistaken, just a little while ago. But again, as I said in my previous video on the S&P analysis, given the fact that we had an on-farm payroll report not be awful, Okay, came in. It was a slight miss. Unemployment went up, but nothing dramatic. So it wasn't terrible. It wasn't a terrible report. It was a weak-ish report, but it wasn't terrible. So not terrible non-farm payroll report. Good CPI, at least on on the headline. Again, I'll make the case again now. That we could easily see a rally from here to the bull market support band. Again, it wouldn't shock me to see a relief rally, a 5 to 7% relief rally. And again, I wouldn't try to drive any conclusions from that rally. I wouldn't get married, as I said to. I wouldn't get married to it, as I said in my previous video, simply because it's still too early to say whether it would be a like this is the bottom, okay, or it's just the beginning of something else. And the reason for that is that we're kind of in a moment in time where we're really being held hostage by the economic data. Okay, so the real next catalyst, as far as I'm concerned, is the PMI report on March 24th. Okay, and that will paint the picture whether whether February's reports were just a fluke or if they were an indication of something more pernicious. Okay, and so I returned to something that is more similar to the last summer, to last summer's weakness. That was really what you have to pay attention if you ask me. But given the fact that again from here to 24th, you have some housing data. Again, you have the FOMC come out that could move things. Depending on how Powell speaks, absolutely. But given the fact that we are in a period of time where economic data has dominance over everything else, and given the fact that, of course, yes, we have as housing data, we have again housing, the FOMC, but there's kind of an air pocket, okay, from here till the 24th. There isn't really anything too significant, in my opinion, to move things, which could give room, again, which could be enough room for the stock market to have that 5 to 7% rally. Could things just continue to kind of take a nosedive? Absolutely yes. But my opinion is that I wouldn't be shocked by a 5 to 7% move in the stock market. Just to revisit the 5,900 level, which happens to be more or less where the bull market support band is. And then we'll just have to reassess from that point on. Again, wait to see how economic data comes out. Okay, if it dismisses February weakness or it confirms it, that in the end will determine the trajectory of things. Okay. While we're at it, it is quite curious. Russell 2000 small caps really had a big move, from let's say 1.5%, nearly 2%, if I'm not mistaken. One point after the CPI release, but that just got completely erased. I am planning on making, I know, in fact, I'll make it today, a video on small caps. So I'll speak about that there. So just to go over as well the JOLTS report we had released on Monday. The most significant data point as far as I'm concerned is the quits rate. And we did see the quits rate go up for the month of January. Now, again, this is quite frustrating because I love the quits rate, okay? I've made that case quite clear. I love the quits rate because it is really the only survey you need, okay? Michigan Consumer Survey, any kind of survey really, the problem with them is that they can easily be skewed by people's political affiliation and other factors. Okay, because you're asking for people's opinion. When it comes down to the quits rate, it's pure signal. you don't get the noise associated with political belief. All you have is what people are doing. It's a survey on people's actions. And as long as the quits rate is low, what people are telling you is that people are acting in a defensive manner, meaning that they're not seeing the excesses they saw back in 2022, which allows them to. Uh, Let me take the bull market band off of this. They're not seeing again abundance in the economy, which is leading them to hold on to their job and not chase extra income in the form of wage increase, which again is feeds into consumption. So coming back to the inflation print, which is why I like to look at them in tandem. Now, given the fact that this is January's data point, it is actually consistent with what I've been saying up until now. The reason and the correlation. In January, saw inflation go up. Generally speaking, quits rate that goes a tick up doesn't surprise me. Okay, I would expect next month's quits rate to be somewhere around 2%, if not slightly lower. But in any case, the moral of the story is more the same. Okay, you have the quits rate low. You have job openings more or less stay steady, if I'm not mistaken. Yeah. And again, this is January's data, so it's quite frustrating. It's like irrelevant at this point. So again, just as far as I'm concerned, this jolts number doesn't really change anything. Again, coming back to what really matters, in my opinion, is the quits rate. It is still at cycle lows. Okay, and so more of the same. People aren't acting in an aggressive manner. Okay, and just to drive the point home, inflation. So we did see. So again, what is the path forward for inflation? As I pointed out in my previous videos, we usually see things pick up, all right, just economically from the end of the fall, from fall to January to March. That's kind of the time frame you have to consider. And just looking at last year, we saw inflation come down in November, and ever since then we saw it go up. We actually saw it go back up to 3.5% in March, only to continue the previous trend that was in place. We saw something similar happen this year. We saw inflation bottom in September and potentially top now here in January. And now continue possibly on its previous downward trend. Could we see any bumps because of tariffs? Absolutely. But as I've said previously, any bump in inflation at this point, given where the quits rate is, given how hiring is sluggish, given the uncertainty that we have because of tariffs, because of layoffs and fiscal tightening potentially coming into play, it's just going to erode people's disposable income as far as individuals are concerned, and as far as corporations are concerned, because consumers don't have that extra income to chase any further price increases. Corporations are more likely to proceed with layoffs, because if you know that you can't pass on that extra cost to your customers, the only weapon you have as a business is to trim your workforce. Okay, and as a leading indicator of that, we have weekly hours. Okay, being at cycle lows, you still have them at 34.1, which is practically what we saw in during the COVID. And it is usually something that precedes layoffs. Okay, so you don't usually have layoffs come first. You see reduction in hours, and then if you know worst case scenario, then we proceed with layoffs. Again, inflation at this point, it's not so much that it's irrelevant. It is relevant. It's just that given all the weakness that you have at this point of the cycle, and again the drags that are coming into play in the form of the of tariffs and layoffs at the government sector, as well as everything else I said, any further bout on inflation is just uh, a an extra cause for it'll just be a drag on growth, is what I'm saying. Okay, so we're not in this regime right here where inflation is it actually has that kind of positive feedback loop. um, we're in a slowdown again. Are we in a recession yet? I don't think so. I think the best way to define it is a slowdown. And in a slowdown, if you have any kind of price increases, it is most likely to cause people to say, I quit. Okay, so spending less, um, and again, spending less, and so growth being sluggish. Okay, so really, tomorrow we have initial jobless claims. Keep an eye on them. And again, don't get too worried about. I mean, I at least wouldn't get too worried about the price action in the here and now. I think in cases like this, the best thing to do is nothing. I know it's very boring, but again, as long as you know you have structural things in the economy working in your favor, and as long as those continue, um, anything in between is just short-term fluctuations. Okay, so could we see a little bit more volatility and a retest of this trend line? Absolutely, but I wouldn't make too much drama out of it. Okay, so just to summarize everything, we had a CPI report come in cooler. Bond market is extrapolating a possible hotter PCI print coming out at the end of the month because of, well, airfares being the reason why we had a CPI report, the CPI report come in cooler, which probably won't show up as much in the PCE report. So that is kind of what's happening in the bond market right now. Stocks definitely had a more positive reaction to it earlier in the day. But again, given the fact that we had a benign non-farm payroll report and a benign CPI report, and given the fact we really don't have many economic data points coming out until the end of the month, yes, we do have some in between things like the FOMC conference meeting come up. I think it's this week, or FOMC right here. Now next week in a week's time exactly. That could move things, but honestly, at this point, as I mentioned many times, it's not about words. It's not about technicals. It's about how the economy is. I mean, really, we're being held hostage by the economy. Okay, that's the way things are, I think. Okay, so pay attention mostly to economic data. Okay, and so yeah, that's how stocks have reacted. And honestly, again, because of benign non-farm payroll report and benign CPI report, I wouldn't be surprised if we have something like a 5 to 7% rally on the back of it. Until we get, I think, PMIs at the end of the month, which could possibly change things. But again, I'm not too bothered about anything in between from here to then. Okay, it's just a matter of staying patient and letting the data come out. Okay, so I'll leave it at that. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.